Now we're going to look deeper into wages and what is happening, not only just on the wages side, but more importantly, what's happening on inflation. And this is going to look up and down the supply chain, looking down to the consumer, looking at CPI, what do we expect going forward, and then looking at PPI and going further up the supply chain to see where we sit in terms of passing some of this through. But one of the charts that I think is so important is this wage growth chart, because this is showing, the first quartile is the lowest rung of people. So the lowest 25% earners are in that quartile. So that's where we're seeing the most increases over time, post COVID. But you're not seeing that on the fourth and third quartile or the people that are getting paid the most. You're seeing that get consolidated, and people. You have to look at corporations, right? So if a corporation is sitting there and saying, okay, I can hire this person at $50 an hour, or I can hire two people at $20 an hour, it makes sense to do the two. And even if we start getting and that's where we're starting to get some of these jobs, like, are we replacing one high-paying job with two low-paying jobs? So how is this jobs data really making sense? And that's where I think when we talk about jobs data on both sides, when we look at it from JOLTS and jobs available and unemployed, well, where's the disconnect? How is it we have so many jobs, but where did they come from? Where is it because the U.S. economy is booming and everything is great? Or is it because we're having some of these jobs are being double counted, some of them are gig economy, and then some of them are just high-paying jobs going away and being replaced by lower-paying jobs that just essentially you don't have to pay them as much. You're still paying them more than you were, but not to the same level that you were paying the fourth quartile. So I think that's an interesting, because the higher you are on the wage scale, the more discretionary income. Typically the person that's going to on 2 vacations a year, buying the extra t-shirt or the extra pair of sneakers is that fourth and third quartile, really not the first quartile. And that's where we get this disconnect on where is consumption going to go from here. And that's, I think, this conundrum that we like to talk about and try to think through. And this is just putting it into perspective on how wide it has gotten and how low it is on the highest earning. When you look at the highest earning, I mean, we're at the lows of 18, 19, again, coming back down, which is where we continue to see this pressure. Even though we're on the lowest earnings quartile, we continue to see that pressure to the upside. So, but what does it mean? How is this money being spent? So increasing food expenditures comprise decreasing budget share as income rises. So when you look at the lowest quintile, spending on food at home, spending on food away, but the share of disposable income spent on food. So the lowest quintile, 37% of disposable income goes to food. So you may say, well, they're making more money, but as we talked about in the first segment, food is also the highest it's been in 60 years. So your money isn't going as far. So even though you're getting a pickup in that lowest quintile based on this is 5 versus the quartile, you're not seeing this huge increase in spending, and that's I think the biggest problem when you look at restaurants, because what's the cheapest? What do you try to get rid of? Well, you get rid of eating out. But then when you look at wages going down or wage growth going down for the highest quartile, the fourth and the highest and second highest, well, what's the easiest place to cut? Well, instead of going out to dinner once a week, we're going to do it once every other week. We're going to do it once a month. All of a sudden, you start to try to get rid of and cut down on these expenses, which is why the wage data doesn't really match up with kind of where the expectations are for spending. And given there's still government transfers, but you had a lot of that come to an end, which is going to become a much bigger problem. So here's just a quote from this. Even with perfect universal access to food retailers, millions of Americans will not be able to afford enough food or enough of the kinds of food to meet their household needs. The food desert narrative overlooks the basic relationship between supply and demand. Increasing the supply of food will only increase consumption if there is enough demand to meet it. In the case of food, demand is suppressed among lower income households. Low income households spend less than a third of what high income households spend on food each year, yet food expenditure accounts for a disproportionate share, 36% of their disposable income. This forces families to make decisions between food, heating, cooling, housing, education. So now take that to the next level. Let's look at natural gas prices, which are currently sitting at, let me just pull up the number. So natural gas prices are at $5.46. So you have natural gas prices at $5.46. You have gasoline prices at $3.16. You have diesel prices at $3.37. People feel good about this? Like you're going to go out and spend all of this free money? No, there is a big problem when you start looking at where is this consumption going to go as government transfers pull back. And to prove that point a little bit further, food was the primary use of child tax credit among households that mostly spent their first payment. So when you look at where is this going, it's because food costs are so high. Like this isn't going to some arbitrary things. This is going to food because food prices have gone up so much that people are continue to struggle, even though rates, they're getting paid a bit more. They're not able to cover just how much those food costs have come up. So they're going to cut eating out as much. They're going to, try to eat home more. But you also have, your needs to heat your home and to send power to it. Well, let's look at natural gas at $5.44. And what is that going to do to electricity prices? What is that going to do to heating prices? What is that going to do to your bills on a monthly basis? Again, the pressure, the pain is there, which is why we talk about some of the issues when we have this aggressive move towards the green revolution. And I'm not saying that it's not good to target some of these renewables and essentially deploy them in places that make sense, but you can't force policy. You still need to respect weather conditions. You have to respect soil conditions. Just what are the demands? What is the exposure to sunlight? What is the exposure to wind? What happens if you have to stress it on both sides? Because again, people don't freeze to death when it's 65 and sunny. People freeze to death when it's 20 degrees or 0 degrees and their heat turns off, or they can't afford heat because prices explode. These are real issues that are going to impact people if we don't get serious and not on a political line. You can be an environmentalist. I have great conversations with environmentalists that sit there and we have a rational conversation of, hey, you want to increase demand by X by having EVs and charging stations and electrifying heat in homes, but where are you coming with supply? And some of the environmentalists and a lot of them, to be fair, will say, well, we have to have some additional natural gas capacity. We have to stop shutting down some coal, utilize carbon capture, maybe even bring back some coal. Look at what is this nuclear going to happen. We're going to talk about in segment 5, the salt, one of the smaller entities within China in terms of their nuclear facility coming online. How is that working? What does that look like? Because we need to come up with a real sustainable question. And this isn't just sustainable in terms of fossil fuels. This is sustainable, reliable. The lights aren't going to go off. The heat's not going to turn off when things get tough, because that's when you lose. That's when you have loss of life. That's when you have these stress periods, which we need. And we're seeing right now in the UK with just this explosion in price. Poor people get hit the hardest with this. If you're someone who's making $400,000 a year, yeah, it's going to suck. You'll complain about it. You might tweet about it. You might create an anonymous Twitter account to complain about it. But at the end of the day, your kids are still going to be fed. Everyone's going to be warm and cozy in their bed, and everyone's going to have clothes. That it's not the same on the other side, and we need to be serious about this instead of just virtue signaling and being foolish. We need to understand, how is this going to impact individuals? How is this going to impact the lowest common denominator. You have everyone saying on how they're here for the common man, but yet all of these policies just destroy them on an economic and cost of living and just living life. So again, we really need to understand where the shakeout is and how we're going to address this in real time. So then when you look at, again, coming to cost of living, home prices, relative to income per household, just look at where we are going back to 1976. When you look at just where incomes are, and you could say, well, rates were so high in the 1970s. Oh, but let's think about this critically. So if you got a 22% mortgage, but you're earning 16 to 18% in your savings account and in your money market account, what is your real exposure to that mortgage? Yeah, and then what happens if you're in high yield debt, if you're invested in the market? You can close that gap. So yes, I'm not saying that rates on homes weren't excessive, but you could actually put money in the bank and have that grow. You could have some of that exposure. You could have some of that growth. So here we have these record low rates. We have record high home prices, but incomes have not gone there. And that's why we talk so much about income, so much about wages, because there's a big disconnect on where the world is headed. And because this isn't just a US thing, this is a global problem that's going to continue to essentially strike at the heart of spending and what this growth is going to look like over the next 2 to 3 years. So then when we look at inflation spikes in 2021, continuing to move up on the euro area and the US, and then the wage growth remaining muted as again, looking at inflation, because as inflation goes up and wages don't go with it, again, you're just hurting how much people can spend. So now we have to look at, well, what are prices going to do looking back through the supply chain? So inflation, PPI came in much hotter in August, up 8.3% year over year. Month over month was up 0.7% versus the expectation of 8.2%. And then in the prior month, core was up 6.7% year over year, 0.6% month over month versus the expected of 6.6%. So we still are continuing to outpace to the upside as we see the cost of doing business. Again, looking at the producer price index, and small businesses are saying it. When you look at what is being said, 3M is talking about inflation pushing prices higher. Caterpillar. These are not small companies. These are not companies that only impact a small subset. I mean, I'm pretty sure if you look around the room that you're sitting in right now, or the car that you're sitting in right now, listening to this or watching this, 3M made probably 20 to 25% of the things within your vision. And that, again, these are things that are going to continue to come through. It doesn't have to all happen at once. Nothing moves in a straight line up or down, but except the S&P 500. But when you think about where this is going, you have to look at where is the trend, and the trend continues to go up on the PPI side, on the industrial side. Whether they can pass that to the consumer is something different, and that's what we're going to talk about in a minute. So when we look at PPI final demand, that's where you can see there's month over month change. We're still at the elevated level, and then core PPI final demand, you're still seeing, again, you're not going to just explode higher, but you're going to go up in this gradual pace as we see these costs getting layered on, as we talked about in segment 1. So now the highest inflation in 40 years, with PPI breaching the 2008 peak. So this is looking at PPI finished goods. So this is the older style finished goods PPI metric, which hit 10.5%, the highest reading since 1981. So, because what we're going to talk about CPI, core. We're going to talk about all of these different things, because there's so many ways to pit and parcel this data to try to get to the number that you want. And we're going to show all the numbers, even if it's not ones that support what we think and ones that do support, because we want to look at what is all of the data saying and what does it mean going forward. So then when we look at cost pressures, so the headline U.S. producer price increase in August by more than forecast, and that's when we continue to see, but excluding the volatile food and energy component, the so-called core PPI advanced 0.6%. So you're still seeing, again, this trend of just elevated going back to May. So from May to August, and so far we know for a fact September is going to be up again. So we continue to see it. And then based on where we are in supply chains, it's going to continue to go up, keeping that pressure in place. But when you look at the most recent data points, US PPI versus CPI, so when you look at PPI going up 8.3%, well, you did get some of that pullback. So you just because PPI is going up doesn't mean you can just push it all down to the consumer. So there is some of this balancing act that has to be mitigated, but the trend is clear on where it's going to get pulled. And that's something that we want to stress, that even though CPI had a pause, it was still up. But even though it had a pause, there's still a lot of pressure to the upside when you go through that value chain and go through the supply chain in general. So when we look at the different economics of it all, let's look at the different backdrops. So Bloomberg, the agriculture index has gotten worse, the energy spot index, industrial metals, all of these levels of the running hot, everything on this side is everything from orange, yellow to red. So you're continuing to see these inflationary pressures either increase or get worse. Some things that were okay are starting to get a little bit less, going from cooler to hotter. So when you look at the underlying capacity, you look at the underlying components, that inflationary pressure is coming through the system as we continue to see moving through August and well into September. So let's look at what drove the inflation in August. So when we look at August 2021, all items, everything was up 0.3%. Unadjusted 12 months was up 5.3%. But let's look at food. So food was up 0.4%. When you look at food in general, when you look at energy, up 2%. So, but when you look at fuel oil, that was down a bit. When you look at energy services, electricity, as we know which way that's going. New vehicles, used cars. So when you look at used cars was down negative 1.5%, but new vehicles was up 1.2%. So then when you look at transportation services, so when you look at some of the reopening stuff, you're starting to see some of that pull back. But then when you look at the core, you look at the sticky stuff, it's still going up. And it's actually accelerating to the upside, which is the bigger concern as we go through August and as we go through the remainder of September. So here's where we provide some of that backdrop. So when we look at core CPI, so in core CPI, August 2020, 1.7%, August 21, 4%. And then you look at Cleveland median CPI, 2.5, 2.4. Cleveland 16% trimmed mean CPI, 2.4 in 2020, 3.2% in 21. Atlanta Fed sticky, 2.4 to 2.6. But then core PCE, 1.5 to 3.6. Market-based core CPI, PCE, 1.4 to 3.3. So again, you're starting to see some of this trend going up and pulling things to the upside with going from, again, measure is more than 0.5% above target. And that's the key. When you look at August 21 versus August 2020, you're starting to run hotter and hotter, and based on where we're seeing this push behind it, it's going to continue to get pulled up on the back of rates of rental rates. So then when you look at median consumer price index, you're still seeing this record high level going back through, I should say near record high levels during this time period, because consumer price index, the median side, is continuing to push up. You're still at the high end, even though we're getting some of this, the August months were a bit better, which is when you look at US core CPI index, you're still trending way above where we were on the trajectory as we continue to see these pressure points continue within the system. And now let's look at commodity price change expectations. So when we look at the expectations of what the Federal Reserve, the survey for consumers, everything is going up. When you look at medical care, it's going up 9%. I mean, I know personally mine is going up double digits. College education getting a bit cheaper, but food is going up. Gasoline is going up. Natural gas is going up. So rent is going up. But the problem is rent is at the highest point. Out of all of these things, rent is at the highest, and we're just starting to see rent get factored into the inflation calculation. So now when we look at August CPI inflation was cooler at 5.3%, 0.3% month over month versus 5.3% estimate. So right in line with estimates. Core rolling rolled over a bit. It was up 4% year over year, 0.1% month over month. So again, you're starting to see some of this just calm down a bit, but you're still at this level. Look at just, if you want to look at less food and energy, we're still at this 4%. We're still seeing this pressure that is not going away, but actually getting more and supported more from things that aren't going to end quickly. And here's looking at the latest update. So the last update, 2.6%. The Atlanta's Fed sticky price consumer price index, a weighted basket of items that change price relatively slowly, increased 2.6% on an annualized basis, following a 3.3% increase in July. On a year-over-year basis, the series is up 2.6%. On a core basis, excluding food and energy, the sticky price index increased 2.3% annualized in August, and its 12-month percent change was 2.4%. The flexible cut of the CPI, a weighted basket of items that change prices relatively frequently, increased 6.3% annualized in August and is up 13.7% on a year-over-year basis. Just to give you an idea of some of these shifts as we continue to see that sticky price, again, trending up, starting to get that turn, because we're not going to see these adjustments happen quickly, especially when we look at shelter and rent inflation year over year. Shelter inflation continuing to go higher, as well as rent inflation, but it just, again, at the very beginning of where we're going to end up as we mark to market and we get the moratorium on evictions ending, we get the moratorium on a lot of these things starting to adjust. So now when we look at contribution of reopenings versus non-reopening factors, well, the reopening component was a drag, and it was a sizable drag. But when you look at non-reopening components, inflation is at the highest it's been going back through 2017. So on non-reopening things, it's going up. Energy is obviously still a sizable chunk, but when you look at non-reopening components, they are going up, not down. And that's what we continue to see, this pressure point. Because when you look at the non-reopenings, that the inflation, well, obviously reopening stuff went to zero when you look at during the lockdowns, but not on the non-reopening stuff. That inflation never went away. You continue to see month in, month out, those prices going up, and now those are accelerating. So then when you look under the consumer airlines, so consumer airlines down 9.1%. So airline fares, huge drop down. When you look at used cars, down 1.5%. When you look at just in general, those two pieces, you're seeing, okay, well, that is going to be a weight on where this inflation is going. But then when you look at U.S. national rent versus CPI OER, we're just getting started, and this is sticky. This isn't just going to be a flash in the pan where, I'm gonna buy airline tickets on September 15th instead of August 15th and save 9%. You don't have that opportunity here, especially given where rents are. So now US CPI, all items less food, shelter, energy, and used car and trucks, you're still over 3%, or as they say, core measure of inflation is still above the Fed's upper band. Again, and there's more behind it when you look at those core entities. So now just looking at it all together, when you put it when you look at the backdrop, so rent. So let's look at rent together. So apartment rent for recent movers, apartment list leads by 5 months, up and out. A tighter labor market will be supportive of some of these rates. And again, that's going to have to pass through. And then productivity growth should drop towards that 0%. So you're going to start to see that labor productivity start coming down. And then the highest year-over-year rate in ages when you look at the ULC and medium CPI, again, supporting this stickiness that's going to continue to push higher. And that rounds out with core inflation will prove stickier than headline inflation through into early 2022. This is showing that energy contribution, but when you look at core contributions continuing to trend up, and now just the core alone mixed with some food, which as we said earlier isn't going away, is now well over that target. And when you look at the core inflation CPI year on year, 24-month, 3-month annualized, you're still at that point of that 3-month level, still showing that elevation. And when you look at, again, that U.S. core consumer price, the reopening boost to consumer prices was partially reversed in August as the Delta variant led to increased travel caution. And that's when you look at hotels were also down 3.3% month over month, which explains the weakest core CPI print since February 2021, but was still positive at 0.1%. These are things that are going to continue to weigh, continue to be that problem. The question is going to be, when does the consumer reject these higher prices? When do you see demand hit? And we're already starting to see some of that weakness, which is that disconnect between PPI and CPI. But it's not going to stop companies from trying, as we've seen from 3M, as we've seen from UNP, as we've seen, or Union Pacific, as we've seen from Caterpillar, Unilever, Kimberly, Procter & Gamble. It's going to be a continued struggle going forward. But now we want to go deeper into unit labor costs and what does that mean for inflation going forward.